Good afternoon. This week's chapter is chapter 10. The topic is financial planning with life insurance. So life insurance is one of the important part uh, to protect your family, right? After your death. So this is one of the important decisions for you. Okay? Right. So this chapter will talk about this like four important goals. First, we'll define the life insurance and determine your life insurance need and distinguish the different types of life insurance companies and analyze various types of life insurance policies. And then, select some important provisions in life insurance contract and create a plan to buy life insurance. And then recognize how annuity is another instrument, provide financial security. Okay. The first one, what is life insurance and your life insurance need? So um, usually, when you buy your life insurance, then that means you're making a contract with the company, insurance company, and then you agree to pay a certain amount of money, which is called premium, insurance premium, periodically. In return, you receive uh, that benefit, your like family, your beneficiary, that benefit was stated sum of money upon your death to your beneficiary. So usually beneficiary will include your spouse and your children. Okay. Beneficiary is a person designated to receive something such as life insurance proceed from the insured. So should be family member, typically your spouse. And then if you want, if you want to go further, and your the kids, usually beneficiary is your spouse, and then that spouse's beneficiary will be kind of the kids. So that's uh, happened that way. Life insurance purchase requires time, research, and careful thought and analysis. So it requires this one because this life insurance is one of the most important and expensive purchases you may ever make. So you should be careful and should be based on a time analysis and research. So your budget should be well planned, right? Purpose of life insurance. You already know that, right? We purchase life insurance to protect the people who depends on us from financial losses caused by my death, right? My death. So it's basically to protect my family financially. So life insurance benefit usually may be used to all those things, right? Pay off home mortgage while death and lump sum endowment for children and provide their education or income for the children. So make charitable donation or provide a retirement income for your spouse, your beneficiary, and actually for yourself too, depending on the insurance type. Accumulate savings and establish a regular income for survivors. Set up an estate plan and then pay estate and gift taxes there. All right. So all these ones are, um, the goals of the benefit, life insurance benefit is to be used. All right. So, principle and psychology of life insurance. Usually, insurance companies have compiled tables, like, about the people's life expectancy, expected life expectancy. Um, so it's it changes from year to year slightly. So this one is 2017. Like 1900, American males life expectancy was 46.3 years. Can you believe it? And now, 2017, it has risen to 76.1 years for men, 81.1 years for women. It's expected life expectancy, right? So basically, the sooner a person is likely to die, the higher the premiums to pay. All right. So this kind of information is the information that the insurance company use here. So look at this as of 2017, males like expectancy 76.1 years and 81.1 years for males and females. All right. And also, at the different ages, like at the age of 30, males have like 47.8 more years to go, and female 52.1 years to go. Right? That's the data that they have. Right? And this one will be one of the information that they use for to process the insurance premium. All right. Now, do you need life insurance? For this question, you have to think about, there are a couple of factors there. So, not the answer is not everyone needs life insurance, right? You have to decide whether you need it or not. For example, if your death would cause financial hardship for somebody, your family, your spouse, your family, then life insurance is a wise purchase. Okay. So usually household with children usually have the greatest need for life insurance. But single people who live alone with their parents have little or no need for life insurance unless they have a great deal of death or want to provide for their parents, friends, and relative, or charity. Okay. All right. One case would be like, you live with your spouse, but your kids are grown up and they are independent. And if you have accumulated like investment account in your retirement investment account, then you may not need that much like life insurance. Okay. Estimating your life insurance requirements, like rule of thumb is like a typical family will need about 70% of your salary for 7 years before your family adjusts to a financial consequences of your death. That means, for example, if your salary is like 100,000, then 70% of your 100,000 times 7 years. So 70% is $70,000 and 7 years. So times seven, that $490,000. So probably half a million in insurance, life insurance company, insurance will take care of this one. Will be like the choice based on this rule of thumb. And dual income, no kid method. So assuming spouse will continue to work, then that one will be like, covers funeral cost plus half of the death plus alpha. That will be enough, right? That will be the outcome for the insurance. Non-working spouse method is multiplying number of years before the youngest child reaches 18. So, for example, if your youngest child is 10 years old, then 8 years to go times 20,000. So 8 times 20,000 is 160,000. Probably 200,000 life insurance will be sufficient for this one. And also other like family needs method that incorporate important factors about you and your family. Um, you know, thorough estimate your life insurance need, and also consider like employee usually provide insurance. Employer provide insurance and social benefit, social security benefit, also a part of the income. If there's any other income or asset, those are all like considering factors in this estimation. All right. All right. Let's talk about types of life insurance companies and policies. There are two types of insurance companies based on the participation and ownership. So stock life insurance company explains about 75% of the entire life insurance companies. It's owned by the shareholders, like in the corporation, and then sell non-participating policies, meaning the insurance policy holders, they are not participating in anything. Insurance companies do not provide policy dividend, so it's any any sharing of the premiums with the policy holders, that do not happen in this type of insurance companies. So if you want to pay same premium each year, choose a non-participating policy with guaranteed premium. Okay, this is the one. So basically, the shareholders, this insurance companies are owned by the shareholders, like corporation, normal corporation. The policyholders, they purchase non-participating insurance, okay, non-participating insurance with guaranteed premiums. But mutual life insurance companies, they are different, okay? About 20 explains about 25%. This one company is owned by policyholders and specialize in selling participating policies. So policyholders, the buyers of insurance policy, they together they own this mutual life insurance company, and the policy premiums, the insurance policy is the participating policy premiums, right? So participating policies, that means they participate in the company's ownership, right? And then sometimes this decision making. So usually participating policy premiums are higher than non-participating policies. All right. And part of the non-participating premiums is refunded to policyholders annually. It's called policy dividend. So that happens in these mutual life insurance companies. All right. I used to have the good relationship with the Pennsylvania mutual insurance companies, life insurance companies. It's called PAMIX. So I invited like president of that company is to Bloomsburg to speak to our student, but that person retired, so he's enjoying his retirement life. So he would not come here anymore. All right. All right. Types of life insurance policies is it's about like how long will the insurance cover, right? So that one is the first one is temporary and then permanent. So temporary insurance, that it will be term insurance, sometimes renewable term, convertible term, and or decreasing term insurance. Well, I'll explain that later. Yeah, there. Explain that what that means or for this one. Permanent insurance is known by different names. Like typically, like widely known as whole life insurance and straight life, ordinary life, and cash value life insurance. Right. So um, this permanent insurance can be limited payment, variable, adjustable, and universal life insurance. I'll talk about it. Other type of insurance policies, group life, credit life insurance. They are, uh, you know, usually a temporary forms of insurance. All right. So group life is the insurance policy, insurance coverage by the employer. And this one here, this is term, usually renewable, multi-year level term, and then convertible, decreasing term, and return or premium. The whole life insurance, limited payment, variable life, adjustable life, and universal life. And other group life is provided by employer, credit life, and endowment life. We'll talk about it. Term life insurance that's includes there. It's like it protection will cover like certain specified period of time, 5 year, 10 year, 20 years, right? If you stop paying premium, the coverage will disappear, right? And renewable term is an option that allows you to renew for another term, So if you have like 10-year term insurance, then if it is renewable, then at the end of the year 10, you can purchase another 5-year or 10-year, something like that. It is called renewable. In multi-year level, that means, if it is 10-year or 20-year term life insurance, then your payment is straight the same premium. Conversion term, it changes from term to permanent coverage. So you can, in conversion term, it allows you to switch from term to whole life insurance, right? Of course, the premium will increase quite a bit. Decreasing term that pays less to the beneficiary as time passes. So and return all premium if you survive to the end of the policy term. Quite unique form. All right, whole life insurance policies that last for insurance lifetime, right? The term life, as I said, is like covers only 10 years, 20 years, right? Or 15 years, something like that. But this one is whole life insurance for the entire lifetime. So whole life insurance is paid out to a beneficiary or beneficiaries upon the insured death, provided the policy is in force. So, at the time of insurer's death, the death benefit or payout is called payout will be paid to the beneficiary or beneficiaries. Whole life insurance has a cash savings component which the policy owners can draw or borrow from. So whole life insurance, the one difference of whole life insurance from the term life is it has cash saving component, right? Cash saving component. So it has like the whole life insurance has both feature of protection, and this investment component, right? So protection components is for death, protection, death benefits, and then this like cash value That one is part of investment, feature. Okay. So usually the cash value of the whole life in the policy typically earns a fixed rate of interest, and outstanding loan principal and interest reduce death benefit. That means if the insurer decide to borrow something and get the loan from against this cash value of the whole life insurance, then that principal and interest will be deducted when they pay like death benefit to the beneficiary. All right. Here, whole life insurance, the different types is a permanent policy for which you pay a specified premium each year for the rest of your life, and may also serve as an investment. I told you whole life insurance has two aspects. One is like the protection, right? Protection, and then investment. Right. Limited payment policies. This one is years. Yes. This one, the premium payment will be for only certain length of time until the policy is paid up. So typically 10 year, 15 year, 20 years. So you just pay with this period for this period, and that's it. That'll cover the whole thing. Okay. So depending on the policy, this one is possible too. Variable life experience, I told you it's the fixed amount payment, but this one is fixed premium payment and minimum benefit guaranteed. Benefit can be greater depending on the earnings of the invested separate funds. So fixed premium payment, but the benefit that depends on the earnings of the invested fund investment, right? Investment. So meaning stock market or bond market, the financial markets like condition and performance, right? Adjustable life insurance life policy allows you to change your coverage as your needs change. That's also possible. Universal life insurance is essentially a term life with cash value. It's kind of hybrid form. It's a term life plus the whole life, right? So term life plus the one important feature of whole life, it is cash value investment feature. So premium amount may be changed at any time without changing coverage. And part of the premium goes to investment account, I told you. So it has it's the hybrid form. So the premium is expensive than the term premium, but is less expensive than the whole life insurance. All right. Comparing major types of life insurance. These are, no. When you want to purchase, when you go to like insurance broker or insurance agent, they will provide like three different types of insurance, right? One is term life and whole life and universal life, right? I told you term life, it covers 10 year, 20 year, that specified period, right? Whole life covers the entire lifetime, but universal is basically term life, but with some investment feature, cash value feature added to term life. Is a hybrid form. Okay. So disadvantages, I mean, why don't you go over this one for some details? Right? These are disadvantages and options. Disadvantages for term life, premium increases with age, no cash value. That means typically term life, if you get the like for example 20-year term life, then your premium stay the same, right? But if you want to change to another term life, usually premium increases. Premium increases. So, for example, if you have 10-year the term life insurance policy, then at the end of year 10, you are 10 years old, right? And then if you want to get another term life, another 10-year um, uh, term life, then premium will increase quite a bit, right? Whole life insurance is costly, is expensive, right? When you're expensive, they are generally expensive, more expensive than term life. It's costly if you surrender early, usually no cash value for at least 3 to 5 years. So first, costly if you surrender early. I mean, this one, uh, if you, I mean, you have to stick to this one for quite a bit, right? Otherwise, you lose a lot. Usually no cash value for at least 3 to 5 years, this attractive cash value feature that will not happen until 3 to 5 years. May not meet short-term needs, of course. This one should be a part of your long-term planning, right? Long-term planning. If you stick to this long-term planning and whole life insurance, then for the end, I mean, later on, 20, 30 years later, this one will be quite attractive. All right, universal is the same as whole life insurance, costly, and then the greater risk due to program flexibility, low interest rate can affect cash value and premium. So as I said, universal is like hybrid form. Um, Usually, I mean, this one, I mean, the key, in my view, the key is if you want to start this life insurance, I suggest you start as early as possible, like 30s, 40s, right? And if you, for example, if you purchase whole life insurance in your 30s, that will be part of your quite important and quite valuable asset and valuable like right part of the retirement planning too. But if you plan on getting whole life insurance in your late 40s and 50s, it's quite expensive. In that case, I don't suggest the whole life insurance. In that case, 50s, you probably go for term life or the universal life, right? Okay. So think about this life insurance company as early as possible. And as early as possible, like 20s and 30s, that will be one of important your investment, right? As long as and as well as your like insurance coverage, right? Protection. So options, like term life insurance, as I said, renewable and convertible to whole life insurance, but the premium will be significant. I mean, they're expensive. May pay dividend if there is like mutual insurance companies and may provide a reduced payout policies. Of course, cash surrendering are permitted. So that is possible too. May pay a dividend minimum death benefit, partial cash surrender permitted. So universal is like in between term and whole life. That's how easier to understand that way. All right. This one is the information that I got from New York Metropolitan Life Insurance Company. It's so neat and so easy to understand there, right? You see that? All right. So, for example, whole life insurance, term life, and universal life, the payment, it says, always the same for whole life insurance. Remain level for a period of time you select, then increases over time. I told you, like if you have the 10-year insurance policy, then your payment is fixed. But after that, after 10 years, if you want to get another 10 years, then your premium will increase quite a bit, right? Increase there. So either you want to like get like 20-year term life, right? Term life and or whole life insurance. If you want to get the 10-year like insurance and that one, okay. But the next 10 year will be the premium will be quite higher. And universal life that can be adjusted. Like payout for loved ones is the death benefit, the whole thing. I mean, all three will pay this, the death benefit. But the build cash value, does life insurance has this investment perspective, investment like the aspect, whole life insurance does not the term life, right? Universal life that depends. It has depending on the policy. So I told you the universal is the hybrid between the whole life and term life. Guaranteed cash value growth that happens that is for whole life insurance, and then the potential earnings that's the whole life insurance, right? You know, look at this one. This one is insurance protection, insurance or protection. But these three are like the investment feature. So whole life insurance has both protection and investment. All right. So term life, that can be switch it from temporary to permanent at like increased premium. Universal life, as I said, is the hybrid. So they may have some of the investment feature in addition to death benefit. That's quite, easy and neat to understand. This is exactly from the New York Metropolitan Life Insurance Company. All right. Other types of life insurance. Look at this one. Group life insurance is a variation of term insurance. It covers like employees under single policies. So no medical examination needed. Usually offered through employers who pay part or all of the cost for employees. All right. So, to get this life insurance, you usually have to go through medical examination, right? Medical examination. But this one, group life insurance, you don't need that. It's automatic. Great life insurance, pay off sudden death, like auto loans or mortgages if you die before paid in full. Also protect lenders, right? So that's kind of expensive protection. Endowment life insurance provide coverage for specific time, pays an agreed upon sum of money to the policyholders if she is still living at the end of the endowment period. That's interesting, right? So funeral expense insurance that pays the policyholders funeral expenses could be expensive, right? But expensive compared to other types. But if any senior people doesn't have any insurance, life insurance, I think this one is a good idea. Or even children, you could you could purchase this funeral expense insurance for your parents. That's also an idea that is widely happen. I mean, I use that way too. All right, provisions in life insurance contract and insurance by plans. So these are all key provisions there, like beneficiary, name your beneficiary, and then the non-contestability clause. The insurance cannot cancel the policy if it has been enforced for specified period, usually 2 years or longer. That is called incontestability clause, and a grace period, usually 28, 31 days late payment allowed. policy reinstatement, non-forfeiture clause, and misstatement of age provision, policy loan provision, suicide clause. So all this one is key important provision. Why don't you go over that? And yeah. And you could, I mean, insurer can change the policy, the condition by adding a rider, insurance policy riders. It's called waiver of premium disability benefit, and an accidental death benefit that usually pays twice the value of the policy if you are killed in an accident. If it happens before a certain age, generally 60 and 65 years, right? Guaranteed insurability options and cost of living protection for against the inflation, accelerated benefits, living benefits, and second to die option. So, yeah, why don't you go over this one here? Okay. Now, to buy this one, now financially strong companies with professionally qualified representatives. So, as I said, you have to spend some time researching and surveying and analyzing all those things, right? So you have to find the right persons, right companies, right? And protection available from a wide range of private and public sources. As the information and sources are, many they are private sector or public, sector. Rating insurance companies. All right, this rating insurance company, the rating of insurance company, you can find the online, and also you can ask the family members and friends and colleagues about the insurance they prefer, and choose your insurance agent. And also within that company, you find the right like insurance agent. In my case, my friend is the insurance broker, so he's taking care of all my insurance, car insurance, home insurance, and life insurance. So, I mean, if you have a good friends like that in the insurance industry, that will help a lot, a lot. Bank insurance company examines private and public sources, and research companies rating by major rating companies. So these companies are the rating institutions for life insurance companies, right? Or talk to friends or colleagues. Choose your insurance agent, and as I said, ask your friend, parents, neighbors for recommendation. Is the agent available when needed? Does the agent advise you to have financial plan? Do you feel pressured? You don't want it? And I mean, yeah. Does the agent keep current with the changes in the insurance field? Of course, there should be. Does the agent belong to professional groups or a chartered life underwriter who require continuing education? This is about the agent professional credentials, right? Credential. We need this. We need this. I mean, we need somebody who belong to this way. Is the agent willing to take the time to answer your questions and find a policy that is right for you? That's important and critical. Okay. So you basically should be confident and comfortable with your agent's like services. All right. So all the details, like all these details are important, but the most important thing is uh, whether your agent, whether you can trust your agent or not, right? Where is it? No. Yeah. Important thing is you find the right agent that you can have confidence in and then comfortable with, and you know uh, when you have questions or need help, uh, you should get that the answers and support quickly, promptly from your agent. Right. Choosing settlement options, like the different ways. So one, like typical one is lump sum payment. If it's like, the 250,000 life insurance, then this one will pay the lump sum at the insurer's death. In limited installment payment, this one the beneficiary will be paid like in installment. And the life income option, payment are made to the beneficiary for as long as she or he lives. Beneficiary, right? Proceed left with the company. Sometimes it is the option where life insurance proceeds are left with the insurance company a specific rate of interest. So it's could be on the beneficiaries like the request choice. Okay, then it will be left. The payment, lump sum payment, will be left with the insurance company until they agreed on the future specific way of the payment. All right. 10 golden rules buying life insurance. So I'll go over this one here. Let me just go over quickly. Understand and know what your life insurance needs are before you make any purchase, and make sure the company you choose can meet those needs. So that means you have to make like research on the different life insurance companies, on different your life insurance need and the companies, right? Buy your insurance company from a company that is insurance from a company that is licensed in your state. Of course, common sense. Select an agent who is competent, and knowledgeable and trustworthy. Important. Shop around and compare costs. It's important too, right? So different companies the offer will be different. So uh, shop around and compare the costs and choose the good price. Of course, with the your research on the company too, by only the amount of life insurance you need and can afford. Told you, like how much do you need for your life insurance protection? Ask about lower premium rates for non-smokers. Yeah, sometimes like if you want to get the insurance, they ask about the whether you smoke or not. All right, read your policy and make sure you understand it thoroughly. Okay, inform your beneficiaries about the kids and the amount of life insurance you own. um, and keep your policy in a safe place at home, and keep your insurance company's name and your policy number in a safe deposit box, and check your coverage periodically or whatever your situation changes to ensure that it meets your current needs. All right. Okay. And last one, annuity. Annuity, we're talking about the different instrument. It's a contract that provides the regular income for as long as the person lives. So immediate annuity provide the income payment at once, and that are usually purchased with the lump sum payment. Think about this one. I mean, let me finish this one. Deferred annuities provide income payment at some future date. Meanwhile, interest accumulate on the money you deposit. So um, uh, deferred annuity purchased with a lump sum payment is known as single premium deferred annuity. This is the case. Let me explain the case there. Yeah. Suppose you have the retirement account, right? Retirement account. And then suppose you accumulated like, half million, $500,000 in your retirement investment account. Now, once you retire, you want this. Once you retire, after you retire, you don't have any the job income, your regular income from your job. Your retirement income, this 500,000, will be your income for the rest of your life there. So you have to turn this $500,000 into your um, the income, your like post-retirement income for the rest of your life. So one way is annuity. So you purchase annuity with certain rate of return, then so you like purchase this the 500,000 with the lump sum, then you get this either immediate annuity or deferred annuity. So once you purchase this 500,000 annuity, then one way is next month or next year, this the annuity payment. Annuity means the same amount of money, a series of same amount of money for a certain period of time, right? So if you purchase like 20-year annuity, then the same amount of money will purchase 20-year or 30-year annuity with your half million like retirement income. Then um, based on all the calculation, this annuity company, this company will pay the same amount of annual income or like a monthly income to you, right? So that is the annuity. So that 500,000 your retirement income will like turned into this annuity payment to you to support to finance the post-retirement life for the rest of your life. That's if the payments would start right away. That's called immediate annuities, right? But if you still have the financial like slack, flexibility, so I don't want payment right now. I want the payment in 2 years or 3 years. Then that is called deferred annuity. Okay. So deferred annuity purchased with a lump sum payment, I told you, $500,000, that is called a single premium deferred annuity. Okay. All right, those are two typical way. But index annuity, that's like that earnings that accumulate at the rate based on the formula linked to one or more equity-based index, such as like an S&P 500. This index is earnings will depends on the performance of stock market. All right, that's it. Okay, now. Why do you buy? Do you want annuities? It provides retirement income for the rest of your life. I told you, right? Now you you accumulate your retirement investment income, either IRA or KIL or 401k there, 403bs, and then this one will be turned into like annuity. It's like variable annuity or fixed annuity, variable annuity, either that annuity. I mean, I said before is the immediate annuity, deferred annuity. It depends on the timing or the starting time of a payment. This one is fixed annuity. That states that the annuitant, the person who is to receive the annuity, will receive a fixed amount of income over a certain period of time or for life. Okay. So, 20 years or until like, till, as long as the person is alive. And then variable annuity, this one is the payment, monthly payment vary based on the stock market or the investment performance. Okay, so the earnings will depend on the income achieved or received from stocks and or other investment. So uh, that's depending on the performance of the invested fund. Some of the growth in the use of annuities can be attributed to the passage of the employee retirement income security. Right? This is about the retirement income security. Right? Cost of annuity. Cost of annuity, you have several. Right? Surrender charges if you withdraw money within a certain period of time, usually like 6 to 8 years, mortality and expense risk charges is equal to a certain percentage of your account value, usually 1.25% per year. So that's the second, the charge and administrative fees is record keeping and the administration expense. Usually charge it as a flat account maintenance fee or as a percentage of your account value. Fund expenses are charged to cover the fees and expenses imposed by the mutual fund. Mutual fund is the underlying asset of the annuities there. Okay, so it is that are underlying investment options for your variable annuity. So it's kind of, you could say, it's kind of double, like, fees, charges. One is by annuity, one is the underlying asset, the funds, right? But that's you have to pay. All right. Tax consideration. When you buy an annuity, the interest on the principal as well as the interest compounded on that interest build up free of current income tax. That's good. Is for usually typically annuity is used by the retirees, so it is the benefit for those groups. Tax Reform Act 1986 preserved tax advantages of annuities and insurance, but curtail deduction for IRAs. Yeah, IRAs is there, but this one got the advantage, annuities and insurance. If you die during the accumulation period, your beneficiary is guaranteed no less than the amount invested. All right, that's right. So drawbacks, reduce flexibility, of course. It depends your life. The financing depends on this annuity payment. And the fees that the lower investment fees, I told you, right? We have the multiple fees for annuities. All right. I think that's it. So, you could go over when you get the life insurance. Let me just summarize this one. You could it's important to find the right company, insurance company, and right agent who are confident and knowledgeable and friendly. So that is important. And then all the details like about insurance details, you could your agent will explain to you. Basically, there are three different types of insurance availability. One is term insurance, second one is whole life insurance, and third one universal, all right, life insurance. As I said, term life covers like specified time period, 10 year, 20 year, 15 year, and 20 years. And then whole life insurance, the entire lifetime. Universal is the in between. You could negotiate that. Okay. And another important like suggestion is you consider this like decision on life insurance. It's basically, as I said, life insurance is the protection of your family, your like uh, your children, your spouse, your children, your family. Uh, and so I suggest you start consider or start think about this one as early as possible in your 20s and 30s. Okay. If you get on late 40s and 50s, and if you try to purchase life insurance coverage protection, it will be quite expensive. But if you start in your 20s, 30s, it will be reasonable and inexpensive. As I said, if you choose like whole life insurance, it has both its earlier ages, like see your 20 years or the 30s, then the cost will be reasonable. And then whole life insurance has both both features of this, protection and investment feature. Okay, so that one I strongly suggest you get this the whole life insurance earlier earlier years. Okay, is for your family and for your kids and for your dear ones. All right. All right. I think we covered everything. Now let me stop. Uh, Stop recording.